They voted Ben Bernanke sexiest Fed chairman ever.
Cool.
It's Sully and Russ on the Big Biz Show.
Big Biz Show, bigbizshow.com. Russ will be back with us on Monday. But happy Friday to you. We added 255,000 jobs, if you believe that sort of thing. What many of you do? It doesn't. Listen, I follow the Brent Wilsey school of numbers coming out of Washington. At least they're consistent. They may not be true, but at least they're consistent. Who cares if they're true, right? If the scale says you weigh $110, if it says that weigh 100, you lost 10 pounds, regardless of what you really weigh, right? That's what comes in. Brent Wilsey's here, Wilsey Asset Management, the founder and CEO of Wilsey Asset Management, wilseyassetmanagement.com. His son, Chase Wilsey, we've been talking to for a while. Before I get to Brent, impart your wisdom on why you think sitting on too much cash is a bad thing, because you hear it all the time. I'm going to go to cash. We're going to go to a lot of cash on the sidelines. Tell me why you think that's a bad thing.
And I do want to preface this by saying we do have cash on the sidelines when things get too expensive. What I'm talking about is I have millennials come to me and say, you're investing that much in the stock market? What about your savings account?
Right.
You're crazy. And I say, no, you're crazy. Why do you have $20,000 in cash in the bank? That means going back to real returns.
What interest rate do you get in a bank?
I believe it's 0.01.
0.01.
Yeah, so if you take the rate of inflation, how many years does it take till you're completely broke? Right?
Right.
Yeah.
I mean, honestly, if you take the rate of inflation over the course of, there's a calculation for that. I forget what it's called, but there's a calculation that'll tell you how much money your investments will be, or your money will be worth half, based upon inflation.
Yeah,
and that's what you're saying. What you're saying is keeping money in the stock market. Putting money at risk is always going to generate better returns than putting it under the mattress.
Long term is what we always look at, because short term, it's like, well, it might make sense to have cash in the bank. You always need liquidity. That does make sense. But if you have $20,000 in the bank as a millennial, that's not making too much sense to me, because the average rate of inflation going back to 1958 is 3.75%.
Yeah.
So that means your real return, if we go back to the average, is about negative 3.74%. if you stay in savings.
So let's get back to real return versus nominal return, because that's what it's the same subject that we're talking about the entire time, right? So when I'm reading on my statement that I've got a 10% return on investment, what I have to take into consideration is any fees that I'm paying, but more importantly, inflation, right?
That's correct.
So how do you do that? How do I project that out? Is there a way, Brent? Is there a way to project that out? I mean, let's say a 30-year-old guy or 40-year-old family is investing, let's say $1,000 a month or something towards their retirement. Okay, how do they project out? I mean, and obviously these are all this is a moving target. How do you project out the rate of inflation, and how much that's going to take a dig into your retirement when you turn 65 years old, when you stop working?
You've got to think about, because there's no way to project it out, what you have to think about are things like what's going to do the best to beat inflation. And one thing Chase and I have talked about is that we looked at inflation from 1975 to 2015. And back in 1975, a new car, guess what it cost? $3,800.
Yeah.
What's the average cost now?
Yeah, by the way, house cost what? $38,000?
New home back then was $48,000. Okay. Now it's $270,000. This is nationwide, not here in San Diego. It's a little bit different and so forth. But if you look at the S&P 500 back then, guess what it was?
I have no idea.
Don't look at my notes.
I'm not. I can't. If you think I can read that far, you forget how old you and I are. So
73 was the S&P 500.
We were at 73.
73.
Guys, look at the chart of the S&P right now. Pull that up there. And this is a good thing to understand.
Right.
Because the time value of money here is the lesson here, right?
Exactly.
The S&P right now is at 2178 and change or something like that. It's 2,100 points higher on over the course of this last 40 years.
And what does that return? 2,960% versus the highest, which was actually college education was the highest. Public education was up 1,000%.
Yeah.
Nothing beat the growth of the S&P 500 stocks. Now we had a lot of terrible times during then. Think about what happened with.
Well, but you've said this before, though. If you've had money at risk for the last 30, in other words, if you had money in the market for the last 30 years, if you had missed something like the top 20 up days.
Right.
If you would have taken your money and put it on the mattress, your return would have been 6% versus an 11% or whatever it is over the course of 40 quarters or whatever it is.
Right.
So the interesting part about that is it's about having money at risk, and it's what he was talking about. It's the difference between return versus a nominal return.
Exactly.
And I listen, for the normal investor, I think the normal, and you guys can tell me if I'm wrong here, But doesn't the normal investor in today's market, post-recession, post-Great Recession, isn't one of their big concerns is holding on to their principal? Or are we switching our values into, because you remember, Brent,
Right.
you and I have been in this business a long
Right.
time, where it was all about how much money can we make.
Right.
Now it's about how much money can we hold on to.
Right.
Right?
And they really mess that up because they're concerned about the principal, but they don't think about the inflation. They don't think about taxes
Right.
and so forth. So you have to.
You got to beat it.
You got to beat it. And you've got to understand you're going to have short-term volatility. When people come to us, we tell them out of a 7-year period, you will have at least 2 losing years. Going to happen, so be prepared for it.
Right.
It's going to happen, but we look at where it'll be 5, 10, 15, 20 years down the road. You're going to have these nice returns of 8, 10% on average, which is probably going to be about 2 to 3% above the inflation rate. So you're getting ahead, not falling behind.
Yeah, and fun facts here.
Okay.
Over the last 20 years, the
Fun fact
average...
for you, by the way.
The average...
For the 3 of us.
Exactly. The average investor is average 2.5% on average per year. Inflation has done 2.4%. So that means their real return has been...
Say that piece again for me.
Okay, so the average investor over the last 20 years has made 2.5% on average per year, nominal return. Inflation has been 2.4%, meaning their real return was 0.1%.
Exactly.
So they have not grown their real net worth, which is it's a problem.
Okay, so my question I think would be, are you guys, since you guys always, not you guys, the industry is always talking about asset allocation.
Right.
Asset allocation. That seems like asset allocation needs to be thrown out the window.
Oh, definitely. And
Right?
Do you know why there's asset
because we haven't ever talked about this. Asset allocation, we should throw that concept out the window.
Exactly.
Tell us why.
I'll tell you why, and I'll tell you why it's there. It's there because a lot of brokers, they're great salespeople.
Right.
They're not financial people.
Right.
So they don't know what to do. So they're told like, okay, we'll put somebody in stocks, somebody in bonds, somebody in commodities.
Yeah.
And you can manage money.
Sure.
Which is
You
a
make
crazy
2.5%.
and 2.5%.
Right.
And that's why also too many brokers get very scared when
Right.
things go down because they don't understand the concept of what's going on. So
Right.
you've got to make sure you're.
Isn't this the same? I'm sorry to interrupt, but isn't this the same concept as a mutual fund or an ETF? We want to mitigate our risk.
Right.
So we're gonna spread it across the board. So when it loses little.
Yeah.
That's no way to invest.
That's no way to invest at all.
You're playing not to lose versus playing to win.
Playing to win. And that's why, again, we talk about the real thing of investing. Education is very important, that you're going to have these losing years, these losing quarters. And we actually love when that happens because when things go down, what can we do? We can buy more at a lower price. It's a great thing to have happen.
Well, I think so too. And I think the other thing that I want to talk about before we let Chase go here today is, the open air indicators that we see, for example, consumer spending and such. Do you ever pay any attention to open air indicators, or are you strictly looking at debt on the books and looking at companies when you talk about investing?
We look at what's going on in the economy because, it is an indicator for business down the road. If people are spending money, that's going to be good for retail companies. That's going to be good for big banks because they can lend more money. So
Right.
that we do look at it, but still, it always comes down to what are you paying for that company.
Okay. So next Tuesday when you come back, we're going to talk about what you geek out on when you look at the 10K and 10Q so the rest of us can understand. I'm going to keep Brent here. We're going to talk about some stuff going on in the economy, stuff we didn't get to cover last week. Brent Wilsey, Chase Wilsey, Wilsey Asset Management, WilseyAssetManagement.com. It is the Big Biz Show, BigBizShow.com. You can follow me on Twitter at Sully on the Air. About 40,000 of you do. Biz TV, Biz Talk Radio Network, iHeartMedia, nationwide, coast to coast, as well as American Forces Radio Network. In 175 countries and all the ships at sea. Stand by. Done.